Are you missing the numbers that could double your e-commerce profits? Here's what you need to pay attention to if you want to run a massively profitable business. Hey everyone, Arjun here, founder and CEO of doola.com. If you are running an e-commerce business, you've probably wondered, am I tracking the right numbers to grow? Well, you're not alone. According to Shopify, 80% of online stores miss key metrics that could skyrocket their success. So by the end of this video, you're going to know the 12 essential e-commerce KPIs or key performance indicators that'll help you boost sales, keep customers coming back, and grow your profits like a pro. Plus, I'm going to show you how Doola's formation and compliance services can set up your business to win big. Let's dive in. First off, e-commerce isn't just about making sales. It's about tracking the right numbers to stay profitable. KPIs are kind of like your business's heartbeat, showing you how healthy your sales, customers, and finances are. Without them, you might overspend on ads, you will lose customers, or you'll run out of cash without knowing why. So for global founders, tracking these metrics is a must to scale smart and stay ahead. So what are the 12 KPIs you need to track in 2025? I'm going to break them down, show you how to measure them, and share tips to improve each one. Number one is conversion rate. This shows the percentage of website visitors who buy something. It's a big deal because it tells you how well your site turns browsers into buyers. You calculate it by dividing total purchases by total visitors, then multiply by 100. For example, if 10,000 people visit your store and 300 buy, that's 300 divided by 10,000 times 100, which equals a 3% conversion rate. If your industry average is 4 to 5%, a 3% rate means you got some work to do. A low rate might mean slow site speed. It might mean a tricky checkout or weak product pages. To boost it, you can use great images, add reviews, add countdown timers for urgency, and make checkout smooth with guest options and multiple payments. Number two, average order value or AOV. This is the average amount a customer spends per order. It's key because a higher AOV means more money from each sale without needing more traffic. You calculate this by dividing total revenue by the number of orders. So say you make $50,000 from 1,000 orders. That's $50 per order. If you were to bump that to 60, you'd earn an extra $10,000 without any new customers. To increase AOV, you can offer product bundles like a phone case and screen protector at a discount. You can set free shipping minimums like spend $75 to save or give loyalty points for biggest orders. Number three is customer acquisition cost or CAC. This is how much you spend to get a new customer, including ads and promotions. It matters because high CAC can eat your profits if customers don't come back. You need to divide marketing costs by new customers. If you spend $5,000 and get 200 customers, that's $25 per customer. If your AOV is only $30, that's really tight. So to lower CAC, target ads to high-intent buyers, retarget visitors who didn't buy, and use SEO or search engine optimization to get free traffic. Number four, customer lifetime value or CLV. This estimates how much a customer will spend with you over time. A high CLV means loyal customers and big profits, calculated by multiplying AOV, purchase frequency, and customer lifespan. If your AOV is $50, customers buy 4 times a year and stay for 3 years, that's 50 times 4 times 3 equal to $600. If your CAC is $40, you're golden. You can boost CLV with personalized recommendations, subscription plans, and follow-up emails with special offers. Number 5, cart abandonment rate. This shows how many shoppers add items to their cart but leave without buying. A high rate means you're losing sales. To calculate it, divide abandoned carts by initiated checkouts times 100. If 1,000 people start your checkout but 650 quit, that's a 65% abandonment rate, which is a red flag. To fix it, you can send reminder emails with discounts, offer guest checkout, add payment options like buy now, pay later, and show trust signals like security badges. Number 6, return on advertising spend or ROAS. This measures how much revenue you make per dollar spent on ads. A high ROAS means your ads are working hard. Divide ad revenue by ad spend. If you spend $5,000 and earn $20,000, that's $4 for every $1 spent, which is nice. To improve ROAS, you can refine your ad targeting, you can test new platforms, and use better ad visuals. Number 7, website traffic and source breakdown. This tracks how many visitors come to your store and where they're from. For example, organic search, ads, social media, or referrals. It's important because some sources bring buyers, others just browsers. To grow traffic, optimize SEO with great content, work with influencers, fine-tune paid ads, and post engaging social media. Use analytics to spot top sources and double down. Number 8, bounce rate. This is the percentage of visitors who leave your site without clicking anything. A high bounce rate means lost sales. It could be slow pages, bad mobile design, or mismatched content. For example, if an ad for organic moisturizer leads to a generic homepage, people bounce. Lead them to the product page instead. To reduce bounce, speed up your site, make it mobile friendly, match landing pages to ads, add internal links, and use clear calls to action. Number 9, customer retention rate. This measures how many customers keep buying from you. It's huge because keeping customers is 5 to 7 times cheaper than finding new ones. Calculate it by taking customers at the end of a period, subtracting new ones, dividing by start of period customers, and multiplying by 100. If you start with 1,000 customers and 750 buy again, that's a 75% retention rate. You can boost it with loyalty programs, personalized suggestions, great support, and thank you emails. Number 10, Net Promoter Score, or NPS. This shows how likely customers are to recommend you. Ask, on a scale of 0 to 10, would you recommend us? Scores of 9 to 10 are promoters, 7 to 8 are passives, 0 to 6 are detractors. You can then subtract the percentage of detractors from promoters. If 50% are promoters and 20% are detractors, NPS is 30. Solid, but definitely improvable. You can raise NPS with great support, high-quality products, and acting on feedback. Number 11 is refund and return rate. This tracks how many orders get returned or refunded. A high rate might mean bad product quality or unclear descriptions. Divide refunded orders by total orders times 100. If 80 of 1,000 orders are returned, that's 8%. To lower it, use detailed product descriptions, improve quality control, offer size guides, and make returns easy while collecting feedback. Number 12, gross and net profit margins. These show how much money you keep after costs. Gross margin is revenue minus cost of goods sold divided by revenue, and then you multiply that entire thing by 100. Net margin is net profit divided by revenue times 100. So let's use an example. If you earn $50,000 with $20,000 in product costs and $8,000 in profit, your gross margin is 60% and your net margin is 16%. To improve, you can negotiate supplier deals, increase AOV, and optimize ad spend. And lastly, remember to watch out for these common mistakes. Chasing vanity metrics like social media likes, ignoring customer lifetime value, not segmenting data, skipping profitability, setting vague goals, ignoring trends, or tracking too many KPIs. Avoid these to stay focused and grow smart. Now, I want to share a bit about why you should choose Doola and why Doola can help here. We are your partner for building a rock-solid e-commerce business. We handle business formation, whether that's an LLC, a C Corp, or an S Corp election, so you're set up for growth. Our registered agent services keep you compliant with state rules. We get you an EIN for banking and taxes. We'll help you with your initial sales tax registration and a reseller certificate, and we have dedicated bookkeeping to help you track your profits. We also handle annual reports and business filings to help you avoid penalties. At the end of the day, with Doola, you are sound and ready to scale. That is a wrap on the 12 essential e-commerce KPIs for 2025. If this helped you out and you found value, please drop a like, hit subscribe, turn on notifications, and you can leave all of your questions below. Our team is ready to help. And if you are ready to build a profitable, compliant e-commerce business, you can book a free demo at doola.com today. We handle all the formation, taxes, and compliance so you can focus on growth and what you do best while Doola handles the rest. Thank you so much again for watching, and see you in the next video.